My name is Zanjirian, and I'm an audit manager at Czarnowski and Beer, a mid-size firm in Midtown Manhattan. Now, when it comes to the co-op and condo world, obviously they're considered corporations, and condominiums are considered associations, but are taxed as a corporation in that way for the IRS. There's tax planning that the buildings could do. We call it a lot of times window dressing to the financial statements that can be done in the event that the board knows or forecasts that there's going to be a surplus for the year. Now, there is a difference between co-ops and condominiums. Cooperatives, for the most part, I would say 99% of the time, because the building is owned by the corporation, have a depreciable asset that they can depreciate on an annual basis. Now we're reaching the point in 2018 where a lot of these cooperatives that were being depreciated over 30 years, 40 years, depending on what method you chose, are coming to an end. Now that you're coming to an end, you don't have what we call a tax shield, in that if there was a profit in one given year, you would be able to offset that with depreciation. So in the last couple of years, it's been very warm. There have been very warm winters. So we had a building that, number one, the depreciation stopped. Number two, they switched from fuel oil to natural gas. Number three, they refinanced their mortgage, so they were having all of these lower cost savings that were going on along in the building, lower utilities, lower interest. Why don't we set aside this money for capital reserves? And what can be done with that is that you could allocate that money to your capital reserve fund or your capital reserves as if it was acting as a capital assessment or capital contribution. And that allows the building and the shareholders to pass along, just like you pass along any capital assessments, to add to the basis of those shareholders. You're also taking this piece, $60, $100, $200, $1,000, whatever the amount might be, and saying we're allocating this in our budget to go to reserves as if it was a capital assessment. And then the building wins in that they don't have to give the money back, and they get to keep it and add it to the reserve funds. The shareholders win because now they get additional basis to their apartments that they bought 20 years ago. And the third part is now this allows the building to have a balanced budget, and when you're looking at your financial statements, you don't see this big $200,000 surplus because you've allocated this money to reserves, and you don't have to answer those questions of, hey, why don't we just get the money back since we had this big surplus. Moving the money over as a capital contribution would be treated the same way any capital assessment is, in that it would not be taxable revenue as long as three conditions are met. The three conditions are, you tell the unit owners, which you either do by putting out the budget or by sending out a letter. You set the money aside into a restricted reserve account, which most buildings have a reserve account, but again, restricted. And third is you have to use that money for capital improvements. If you do those three things, that will act in a way that it's a capital contribution and would not be added to the operating revenue of the building. Okay, so let's talk about condominiums. We're not trying to make money in a condo, no different than a cooperative. So in this situation, similar to what we have with a cooperative, and you're looking at your next year's budget and saying, oh my God, I'm going to have this big surplus. So they say to ourselves, let's allocate that to reserves. Like we said before, set aside into a restricted reserve account, spent only on capital improvements. Unit owners were notified. It gives you a better, what we call window dressing, where your financial statements look are not showing bigger surpluses to the unit owners. You're saying, hey, we had this extra funds, and we took these extra funds and we put them into the reserve fund, and we're going to use that reserve fund set aside for future capital improvements, and when those happen, we're not going to have to assess you. And that's the tax planning that we do, that we always try to encourage. And I don't know if a lot of boards know about this, that when they're sitting down, right now we're in May, but when you sit down in September and you're looking at 2019, this is something that you should be looking at and saying, hey, are we projecting for this year a surplus? Are we projecting for 19 a surplus? And if we are, what should we do about it for those years?